everybody, Flip and Danny here, founders of the Freedom Real Estate Group family of companies. Welcome to another episode of our podcast called
Freedom Through Passive Income.
That's right. And today our episode is called Cash on Cash Turn. Now this has nothing to do with Johnny. This is cash on cash return. You know Johnny Cash? No? No?
At the beginning, I thought you said cash on cash turn. And I was like,
cash on cash return. Return.
Are we turning a property?
Return.
Okay.
Return.
All right.
Cash on cash return. Has nothing to do with Johnny, you know, the singer. Right? No? Okay.
Oh my gosh.
And so we're going to explain how to calculate it and why it's important.
Are you done?
I am. Thank
Okay.
goodness.
I'm going to take over now. So you're going to start by calculating it. You're going to figure out how much you put into the deal. So that could be your down payment. That could be other fees. It could be closing costs, whatever it is. You're going to calculate at closing, how much should I pay in cash to get into this deal. The second thing that you're going to do, cash on cash returns are typically calculated over a period of 1 year. So over 1 year, you're going to want to understand how much of the money that you kept from the return. So you're going to have your income here. You're going to have all of your expenses. Do not forget your mortgage.
Oh.
That's a big piece of the cash on cash return.
Yes, it is.
So income, all expenses, minus your mortgage, that's going to be the bottom line number. And all of this is pre-tax, by the way. That's going to be the second number that you're going to use in order for you to calculate the cash on cash return, which you're going to talk about
Right.
in just a second.
Before I get into the calculation, make sure you hold smash. Don't do it while you're driving. But again, if you're on YouTube, Facebook, LinkedIn, whatever, social media, and you can get that like button, that love button, make sure you hit it right now. Again, this is all for the algorithms of whoever
Whoever does this stuff.
Yeah. But anyway, make sure you smash that button right now.
Please and thank you.
Yes. Okay. So the calculation. So you want to take that net income that you just talked about, the last 12 months pre-tax.
Yes.
You're going to divide that by the actual amount of cash that you invested.
Yes.
Okay. That's going to equal your cash on cash. So say at the end of the year, that calculation gave you $3,000.
Yes.
That's everything.
Yes.
Minus expenses, minus your mortgage, everything.
Yes.
$3,000.
Yes.
But you put $20,000 down when you bought, or down or in or whatever. You spent $20,000 when you bought the house.
Yes.
Okay. So $3,000 divided by that $20,000 equals 15%. So your cash on cash number on this property would be 15%.
Which is not a horrible number. That's actually pretty good.
No, that's very good.
So why is this important? This is important because if you are financing something, well, there's two reasons. If you're financing something, you want to be able to compare two vehicles, right? So if I put this much down versus this much down, what does that mean to me later? Is it better to put only 3.5% down, 5, 10, 25, depending on the type of loan that you're getting? This is one of the reasons people calculate the cash on cash return, is to evaluate financing programs to see how much they're going to put in, and then what is there going to be their estimated 12-month return after a mortgage payment. What is that return? And then they compare the other lending program and do the same. And that gives them a higher cash on cash, the better that it's going to be. Now, the other thing that you can do is evaluate properties the exact same way. If you're going to buy this property and this property, but you already know what type of mortgage that you're going to do, plug in the numbers of how much you're going to spend on this one, how much you're going to spend on this one, what is the net amount that you're going to have after it's all said and done, including your mortgage payment, and compare those two cash on cash returns.
Yep.
So that's why it's important. That's why people use the number. Us personally, we evaluate almost everything by cap rate because we use so many private lenders in everything that we do, or we're taking loan assumptions, or there's just a lot of different variables. Right. But so we evaluate primarily by cap rate, but a lot of people do use cash on cash return. And if that's you, and if you feel that's better for you, we wanted to be able to talk about it, explain it, and share all this info with you.
Well, excellent.
Hulk smash. Do the Hulk smash.
Hulk smash. Hit that like button. Hit that love button. Again, comment, please. Comment, questions, recommendations. Let us know how we're doing. If you're driving, obviously do this later. But if you're watching us right now, you're probably already on the Facebook group. But if you're not, right up here, facebook.com/groups/
Freedom Through Passive Income.
There you go. LinkedIn, we don't have one of the cool URLs, but go to LinkedIn, go to the search bar, type in
Freedom Through Passive Income.
Freedom Through Passive Income, and you'll find our group that way. But we're also at TikTok, Instagram. I think that's it. Facebook, LinkedIn, YouTube. Go to YouTube. Make sure you subscribe to our channel on YouTube. And that way you get notifications when we have another one of these episodes releasing.
That's right.
Which is every day.
365 days a year.
Well, we like to keep these short and sweet, and we also like to end with
invest smart,
live happy. Bye, everybody.
Bye.
Nothing in the show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions and information on the show are not guaranteed. All investment strategies have the potential for profit or loss.